Welcome to Keep What You Earn, your judgment and jargon free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So, if I were to ask most entrepreneurs right now what their exit plan was for their business, most people wouldn't actually know the answer. And that's okay. It's okay to have uncertainty as to what's to come in your business and really what's in store for it, and have it adapt to your goals as well. But sometimes people find themselves in a very sudden position where there's an offer to buy their business, or they're in a position where they have to sell it. And very often they're caught off guard by the information they have to have ready and prepared to be ready for that moment. And much like tax season every year, if you don't do your books, if you don't keep up to date records, if you're not staying organized, then when the time really comes to show up and deliver on those things, it can really hurt you. So, I'm going to tell you three things that you need to have ready, even if it's not really in your horizon right now to sell your business. But if you know that that is a possibility in any realm that you might want to sell it, it's so important to have these types of things aligned. So, number one, when you get an offer to buy someone to buy your business, you want to make sure that the price and the terms are super clear and that you're completely in alignment with everything that they're expecting you to do and what you're expecting them to pay. So, I would say do not gloss over the contracts. These are very complicated contracts. I'm currently watching a sale happen with a client of mine, and I shouldn't say watching. We're actively participating in the sale of the business, right? We're advising as CFOs, but what's happening is I'm watching the back and forth. I'm watching negotiations, and there's several elements to the agreement, right? So there's several elements here from the purchase and sale agreement, which is just we agree to purchase XYZ business at this price, right? Secondarily, there's a loan involved. There's going to be a loan component of the deal, and there's a consulting agreement. Very often, what you'll see is buyers of businesses will work in terms like that you will consult for the business for X number of years, and that they'll separately engage you as a contractor in order to serve as a consultant for X number of months, years, whatever that may be. And then that should be really laid out in terms of the expectations, the satisfaction of that contract, what constitutes a breach, what are you expected to do? Where do those services have to be provided? How do they have to be provided? Is there some type of required response time? Things as detailed as that, right? So you want to be super familiar with what are the terms and expectations that you're expected to fulfill on, and how can you make those work in your favor or in alignment with where your goals are. And do you really want to get involved? You may get this kind of these rose colored glasses or see the dollar signs, right? And a lot of people see these transactions, they'll see millions of dollars on the table and go, yes, yes, whatever they want, yes. But slow down, take a deep breath, read the documents. Not everything is set in stone. And obviously, you're not going to lose the whole deal over countering with a few different terms. Very often, business owners are usually not experts in what we call legalese, which is the language of the lawyers, right? The contracts. So very often the one side will have their lawyer draft the agreement, right? And then the other is expected to read it and counter. But what can be tempting is if you're on the other side, then you might want to just accept the terms for the sake of closing the deal faster. And I'd say wait. Usually these terms are drafted favorably toward the party that drafted it. So you want to make sure that you're pushing back in the necessary areas. You get a lawyer involved on your side. You get possibly a tax attorney also involved to advise on the tax considerations of a sale. So you want to pay attention to that as well. You also want to pay attention to the purchase price, and you want to pay attention to the tax impact to you. So that leads me into number two. The number two thing you need to understand fully, along with the terms of the agreement, is exactly how much you're going to have in what's called, and we're going to do the jargon thing for a second. Hold on. Depreciation recapture. Depreciation recapture basically means that if you took what we'll call early depreciation, see, as you know, depreciation is where you buy an asset, let's say it's a building or a vehicle, you depreciate it on an accelerated level. So instead of spreading it out over 5 or 7 years, you take all the depreciation in 1 year. You may remember this from, I don't know, any TikTok video saying you can deduct a G Wagon and write it all off, right? So you can depreciate it fully in the first year of operation if it's a heavy vehicle or if it meets all the criteria, right? So here's where that gets tricky and muddy. They don't tell you about this little catch. If you're going to sell your business, what they'll do is look at how much depreciation did you get that you didn't necessarily, quote unquote, earn yet. So, how much depreciation did you accelerate into the earlier time that should have been recognized if it had gone on the normal pace? It should have been recognized over time. So, how much did you actually accelerate? And therefore, how much would have to be recaptured as depreciation? That's the concept of it, right? The calculation of it's a bit more complicated. I'm not going to get into that, but the concept of it is recapturing the depreciation that you've taken on the assets. So, what we have to do is look at how much you've actually purchased in assets, how much you've depreciated of those, and how much of that is going to end up being recapture based on how much the seller, or excuse me, how much the buyer is going to pay for your business. And this applies when there is what's called an asset sale, when you're selling your assets of your business to the buyer. Now, a stock sale is different. A stock sale is when you're selling your ownership of your business. It's very straightforward, it's very easy. A stock sale is the most advantageous to a seller if you're selling your business. A stock sale is generally the most advantageous. An asset sale is generally more advantageous to the buyer. Why? Because they get to claim all those assets and purchase them, and then they get to restart the depreciation clock from scratch. So they can then depreciate a bunch of your assets fully in the first year based on how much they paid for them. That's pretty huge. So if you're buying a business, you want to lean in the asset sale route. If you're selling your business, you generally want to lean in the stock sale route. Of course, there are exceptions to this left and right, but just to know that that's where you might be wanting to head. Now, why this matters for you is you want to pay attention to the tax impact of both scenarios, and you want to pay attention to the terms of the agreement again and how they relate to that scenario. So, for example, my client wanted a stock sale. They wanted to sell their business on a stock sale. The buyer wanted to come to the table and do an asset sale, right? But they understood that there was going to be a significant tax impact to the seller because the seller depreciated a bunch of assets fully in their first year of operation. So, and it was fairly recent. So they knew there was going to be a lot of depreciation recapture, AKA a lot of money that the seller would have to pay taxes on in that transaction. And that's no bueno, right? That's not good. So, in order to come to the table and come to an agreement, what ended up happening was the two parties agreed to do this election in order to make sure that they could treat the transaction the way that they wanted to. There's a 338H election, a 336E election. There's all these different elections you can take based on the code that will enable you to get a little bit of the best of both worlds and come to the table and meet in the middle because there's just such a difference in the benefits between these different types of transactions. So what ended up happening was we took one of these elections, and that way my client got beneficial tax treatment in some cases, but we still had to do depreciation recapture, we still had to do all those calculations, but the agreement was that the buyer would increase the purchase price or modify the terms of the agreement such that the client was made whole, so that the taxes did not become a factor, that they would walk away with the same amount of money regardless. So understand that there's a lot at play here, that you can make sure that you're getting a fair deal. You can make sure that you are able to walk away with the same amount of money that you would have gotten in the most advantageous way If you know your numbers, if you're prepared, if you come to the table and you say, I have a whole balance sheet here. I know exactly how much my assets are. I know exactly how much cash I have in the bank. I know exactly how much I have in depreciation. And you know exactly what your basis is. You know what your equity is. If you have a strong balance sheet that's updated, then you're unstoppable in one of these deals because you came prepared and you know exactly how it's going to affect you. And that is why it's so important to have clean financial statements. It's not just about making accountants happy. It's not about just us saying you have to go do this and eat your vegetables. It's about us having your best interest in mind and saying, hey, when you go to sell your business, you're going to be screwed if this isn't ready. And you're going to have to scramble and you're going to have to, estimate and you're going to have to round and you're going to have to ballpark it and you might lose. You might lose in this deal because you weren't ready. And these things move pretty fast. Okay. Like these transactions move very fast because when someone wants to buy a business, they're like, I want to close on this ASAP. When can we do it? Right. And it's going to take you a lot of time to prepare these things, not to mention you're running a business. Right. So you want to make sure all of this is in line and it's ready to go. And then finally, what you want to have ready and you want to understand is if you have an S corporation or you have a partnership and you are selling your ownership in that entity, you want to make sure that you understand what's called your basis. Your basis represents what your ownership of that company is worth in dollars. And it's based on activity like putting money into the business, taking money out of the business. It's based on the operations and activity like your net income or your net losses. So your basis will go up and down with these fluctuations of what your ownership is worth in the business. Now, your basis can be found in your tax return. Your tax professional should have prepared what your basis is in your business. So if you're selling, let's say your basis is, I don't know, $75,000 and you're selling your business for $100,000. I know this is really low numbers, but for the sake of the argument, right? Then that means you're going to have a $25,000 gain on the sale of your basis, the sale of your stock. And then that's capital gains, right? That's capital gains. Capital gains is what you're taxed on, is the level at which you're taxed over and above your basis in the company. So if you have a really high basis, congratulations, because now you can actually sell your business for a small capital gain or maybe even no gain at all. Maybe no gain at all. So it's important to understand what your basis is to figure out what is my ownership actually worth. So if I accept a purchase price, do I understand how that's going to affect me? And similarly, we'll go back to number 2, your depreciation recapture. How have you been depreciating your assets? And will that actually serve you in the long run? And then finally, back to number 1, the terms. It's so important. The price is not the only thing that you should be looking at when it comes to selling your business. It is very important, but typically the terms are where it's at because the price can always be the same, but the terms around which you get paid, how you get paid, when you get paid are huge when it comes to you deciding whether or not to take the deal. So I hope this is helpful. Remember these 3 things when it comes to selling your business and make sure you are well positioned if that deal ever comes through. Sometimes don't you wish you could just Google or ask ChatGPT what is deductible for your taxes? I wish it were that easy, but the truth is that deducting something can really vary and it's really hard to get a straight answer for your business in particular. But I made something to help. My free tax deduction guide walks you through hundreds of example tax deductions that can apply to your business, along with a mini training on what actually makes something deductible so you can add more to your list and cater it to your specific industry or type of business. This is all for free and it's at the link in the show notes. Go check it out. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.